Hello folks, Steve Lentz here with Discover Options. Welcome to this edition of Market Timing Reports for Advanced Options Traders. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome everyone. We have three reports for you today. The Condor Butterfly Timing Report, the Bull Put Spread Timing Report, and then the Directional Likelihood Report for the S&P 500. This will be for Friday, March 23rd, getting ready for the open on March 26th on Monday. Before we get started, if you could please hit the subscribe button. That way you'll get alerted when we come out with new videos in this channel. And also, we have a free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click the link, give us your information, and we'll get that right out to you. It was pretty brutal here for the S&P 500 this last week. We had two consecutive downswing bars occurring underneath the 50-day simple moving average. Friday was well above, in terms of its average true range, it was well over 1%. And in terms of the stochastics, the 15-3 stochastics, it is right down there between 0 and 30 in oversold territory. And trending underneath its percent D, the 3-day simple moving average. So this market condition is not as rare as you would think. It's actually occurred well over 170 times since January of 2000. So we have a pretty good population of occurrences of this market condition to look to. So let's go to the first report. This is for the those of us that trade condors and butterflies and like to sell options premium from a market neutral perspective. Since January of 2000, we've had about 4,574 daily closes of the S&P 500. Okay, now of those 4,574, 64.7% have been favorable bars for selling option premium where the actual subsequent movement of the market was less than what was being implied by the option prices. Okay, so 64.7% of the time, the market doesn't move as much as what the option prices are implying. Now, also since January of 2000, this current condition I just described has occurred 173 times. Now, of those 173, 56.6% of the bars were similarly favorable for premium selling. That's a lot less than the benchmark of 64.7, and so we have an option premium selling edge of minus 8.1%. So statistically, it's more likely than usual that this market condition will end up being an unfavorable one for market neutral option premium selling. Okay, so that's the Condor Butterfly Timing Report. Doesn't look good. Now, does that mean that if you trade a butter and Condor, it's guaranteed you'll lose money? Well, certainly not. 56.6% of the time, things work out when you look back at the past occurrences of this market condition. However, okay, that's not as much as just what the benchmark is. And so if you want an edge, you would wait for a different market condition than what we have right now. Okay, now that's if you want an edge. Now, if you have to trade, that's one thing. Just be aware going into it. You may need be a bit more on your toes and a bit more conservative on your adjustments. Now, the Bull Put Spread Timing Report is for those that like to sell put premium, a standard deviation out of the money, roughly 30 days out. That's what this report is predicated on. So we've had 4,574 daily closes of the S&Ps. Now, of those, dating back to January of 2000, almost 83% of the time, those bars have been favorable. The conditions have been favorable for selling put premium like that, where the actual downside movement over 30 days or 21 bars was less than what was being implied by the option prices. Okay, so roughly 83% of the time, you can sell put premium and the market's not going to, a standard deviation away 30 days out, and the market is not going to go down and touch that strike. Roughly 17% of the time, it does move down and touch that strike. So that's the benchmark historical level. Now, We have 173 occurrences of our market condition here, and of those occurrences, pretty much the same. 83.2% of the bars have been similarly favorable. So it's pretty much a wash. Okay, it's pretty much a wash because, and one of the reasons is that with the with this market going down so fast and so much, the VIX, the skew-adjusted VIX to the downside, has subsequently also blown up. And so your one standard deviation strike is going to be pretty far out of the money, all right, into this market condition when you run those numbers. And so that's why you have a kind of a wash when it comes to the bull-put spread report as opposed to just the Condor butterfly report that we saw previous. Okay, so that's it for the bull-put spread. It's pretty much a wash in these conditions. But more interestingly, let's go to the market likelihood report for the S&P 500. Here, we're trying to answer the question based upon past occurrences of our market condition that we described. What's the market likely to do? Go up, down, or wobble around for a bit? And before I get to this report, just to review how we answer that question, we use what's called price distribution bands. And what we do is we go a standard deviation out of the money to the upside and the downside. And we locate these bands. And in this case, we have 5-day bands. And we just simply monitor for each close whether the market goes up and hits the upper band, goes down and hits the lower band, or wobbles around and stays in the middle. And we note that for every close going back to January of 2000, and that way we get a statistical understanding of price distribution. Now, and we do this not only for 5-day bands, but we go out and look at the 10-day bands and also the 15-day bands, and then we run those statistics. And so we can see up at the top here, for the 4,574 occurrences, the upper 5-day band gets struck or got struck roughly 22% of the time. The upper 10-day band, 16.4. The upper 15-day band, 15.7. On the lower side, underneath the close, the lower 5-day band, 16.5, 16.7. And then the lower 15-day band got struck 19.6% of the time. So that is the benchmark price distribution going back to January of 2000. Now, let's take a look at the occurrences of our current market condition. This 122, these are non-consecutive occurrences. Previously, the 173 I told you about, those included consecutive occurrences. These 122 are non-consecutive occurrences. So, with that in mind, let's look at the statistics here. All right, when this condition has occurred, of those 122 occurrences of our current condition, all right, the upper 5-day band is struck 21.3% of the time, which is very close to the historical benchmark. The upper 10-day band got struck a little over a quarter of the time, 25.4%. That's quite a bit more than the benchmark of 16.4. You can see the blue number is the difference, 9% more. It's a lot. The upper 15-day band, 21.3, again, much more than the historical benchmark. The lower 5-day band was struck just a little bit underneath the historical benchmark, but then on the lower 10 and 15, very, very close, just a little bit higher. Just a little bit higher here. So if you were to look at these numbers and try and determine a directional bias, we would note that the upper bands are struck more often, in all three cases, more than the lower bands. Do you see that? Interesting. And so we would lean it a little on the bullish side if you had to lean one way in terms of statistics. However, all in all, we see a picture here of 4 of the 6 bands have blue numbers underneath. This is being a picture of greater market volatility. Okay, greater market volatility in general. Now, let's break this down a little bit. Let's break it down in terms of whether price exceeds Friday's high or price exceeds Friday's low. If price exceeds Friday's high, again, we can see 4 of the 6 bands have blue numbers have greater occurrences of getting struck. All right, some of these by a substantial margin. And then if price exceeds Friday's low, all 6 bands are getting struck more often. So again, a picture of greater market volatility in general going on here. But, and in this case, boy, you can kind of see some big numbers across the board. I'd be hesitant to lean it one direction or the other, judging from both of these, just looking at these. Interesting, very interesting. Okay, so folks, thanks so much for joining us. That concludes this edition of the Market Reports. Let me get out of here. Boom, there we go. I'm Steve Lentz with Discover Options. Thanks a lot for joining us. Take care. Have a great week. Bye-bye.